Hey, good morning, everyone. Marty Mazzora here. It is Friday, the 9th of January, 2026, with a brief update for you. Didn't do anything in the middle of the week, just didn't feel compelled to, in all honesty. I mean, there's so many moving parts in the short term right now that I just kind of like to see some of them unfold a bit and then report on them, after the fact. And actually, the one thing that when I say that, it's really one thing that's coming to mind right now, and that is the Supreme Court decision on tariffs, which was supposed to happen today, which did not happen today. So I assume that's forthcoming in the near future, but it didn't happen today. What did happen today was we got a jobs number that was up 50,000 when it was expected to be up 70,000. And looking at the market reaction, I would say that was a net positive in that it makes it easier for the Fed to cut rates sometime this year. The January meeting, last time I looked, was very low odds of a Fed rate cut, but as we get further into the year, they seem to go up. That's interesting to me because as we get further into the first half of the year, we're going to see, from what I understand, record tax refunds to consumers that they will no doubt spend. And I think a not small amount of oomph is going to be coming by way of the One Big Beautiful Bill Act, the OBBBA. So it would make sense to me that the economy actually doesn't look too bad in the first half of the year. Those things considered. Other things, of course, could get in the way. Now, with regard to tariffs and the Supreme Court ruling, I've been fascinated by the opinions as to what it would actually mean. I read a post on X yesterday where someone who presumably had some credentials and was pretty smart was talking about how if indeed the Supreme Court were to determine that the tariffs were not constitutional or not legal, and the refunds were going to go to the importers who paid the $600 billion, I guess, so far in tariffs, that would be very detrimental to the market. I suggested that no, that probably isn't the case, and let's just use what happened back on November 5th when the White House's representative was being very harshly, or let's say challenged by the Supreme Court in a way that made it sound like they didn't think that these things were legal. And the market had a really nice day that day on that news. When you read the PMIs or the ISMs, these are business surveys of both manufacturing and services, companies continue to complain passionately about what tariffs are doing to their businesses. So on one end, you might argue that all that revenue going out of government coffers is a really bad thing, right? Because we're already running massive deficits. Imagine losing that revenue or having to give that back, what that might do to interest rates. And by the way, that's the risk I agree with, is that would be just additional substantial oomph, as I like to say, into an economy that's not right now rolling over into a recession. So while equities probably wouldn't know what to do with that news to begin with, they may indeed sell off, but ultimately that's probably positive. But from an interest rate standpoint, from an inflation standpoint, it could be quite negative. And I always have to reference 2022 as a year where stocks went down 30% peak to trough at one point, down 20% by the end of the year for the calendar year, spawned by higher inflation, higher interest rates, a Fed that felt like they needed to be tightening monetary policy at that time. And so this year, as we go in, it's not the Fed. They may be cutting interest rates. They may be getting at least one very important appointee here shortly who would do what the president wants him or her to do, although it's a committee, as you know, or as I've talked about. So the chairperson doesn't get to act unilaterally. But if you do have on balance, very dovish Fed, well, I guess at the margin that could be good for liquidity. The fiscal authorities at the government end is actually going to be putting liquidity into the real economy. The Fed's liquidity is very good for financial markets. What the Treasury is talking about is more about the real economy. Therefore, we want to own things that benefit when we get this real economy stimulus. And that's what we've been doing. And that largely led to our exceptional year last year. And so far this year, we're kind of picking up where we left off. We have made a number of adjustments to the portfolio that we feel good about, but we do think this is going to be a year characterized by a lot of volatility. And so definitely we're going to have our good and bad days as we go forward. So I could ramble some more, but I just think we need to kind of just sit back and watch things unfold and act accordingly, and I'll comment accordingly as we go. As for the technicals, you have the S&P 500 one-year daily chart in front of you. I just want you to notice that go back here to the end of October, the market really hasn't gone anywhere, right? It's literally in a consolidation phase. Call it an ascending triangle, right? Today you can see we are bumping above this right here, trying to break out into all-time high territory, and there will be a breakout from this pattern. There's no doubt about it. The momentum indicators on the daily charts are saying that, they're not, this doesn't mean we won't get an upside breakout, but this says its upside capacity is probably pretty limited right here. These are these long bearish divergences that tend to resolve themselves with something more than a 2 or 3% correction. So there's definitely that heavy, if you will, technical risk to the market, at least in the near term. When we look at the NASDAQ 100 index, it's got more of your classic triangle pattern, right? And that is again, it's not bullish or bearish, it's a consolidation. And we don't have bearish divergences. We actually have momentum that pretty much is moving right with what we're seeing. And that is, a triangle, obviously we have lower highs and higher lows, tend to break out of these pretty aggressively, if not violently, in one direction or the other. This doesn't tell us what direction that's going to be. Would not surprise me to see some downward action, but it wouldn't surprise me to see us break out to the upside, particularly as, perhaps these tax refunds or something like that, inspires more people to come rushing in. The gold has been on a tear, and remember I talked about this last time. We had this long consolidation phase. I was telling you we probably had some real downside potential here, or it wouldn't surprise me. And what did we get? We got a strong breakout to the upside. All the while, we had these long bearish divergences, just like I showed you in equities, right? So it's the beauty of markets. Technicals can get defeated. They talk about probabilities, but a lot going on in this dynamic world we live in that can change things a lot. So, we do have a new buyer in gold, or a new element, and that is big time central bank buying. And a lot of the gold bulls think that's just going to take us infinitely into some higher horizon. Here we are again, new consolidation phase, huge bearish divergences, overbought here. We had a nice big down gap here a few days ago. That gap has been filled, as they tend to be. This would be resistance. Gold has been up and down today. It's actually up as I speak, a little more than 0.5%. I do think there's probably a pretty good correction to be had in gold in the not too distant future. That's my base case right here. Silver, we talked about, we own it. We did cut it with our new allocation. We still own some, and here we are, with just a massive move in silver. It's kind of like a meme stock, some of the stuff that's been sent my way. YouTube YOLOers and talking about, the U.S. having to buy millions of ounces from China, yada, yada, is complete garbage. I mean, we're getting the kind of AI-produced pumping that just isn't happening in many cases. Silver is a very viable commodity to own. We are long-term bullish on silver, and we're really glad we've owned it. It's becoming a little ridiculous in terms of the parabolic move that we've had here. Remember, I told you don't get these without big sell-offs. Here we've got a sell-off. Here we're retesting levels that we've been before. I guess we need to retest this level right there on a closing basis. But we've cut our position. We still own it, but unlike gold, where we're hedging with put options, and we did cut that a little bit, we cut silver and platinum notably, and so they're not as big as they were, but we're still in them enough to benefit from what's been going on. You can see the platinum chart. These are kind of like your island reversals where you have big gaps on both sides and then you fill those gaps and so on. Platinum's rallying today a couple of percent as well, bearish divergences. I love platinum on a long-term basis as well, but on a short-term basis, I don't like it at all, to be honest with you, technically speaking. So, hope to be buyers again if we get a big correction, or if the narrative, adjusts and allow us to go in even at these levels right here. Still own it, but not as much. The dollar, our long-term thesis is a weaker dollar. You can see that played out very much in the short term this last year. That was very good for our current investment style. Right in here, we called this bottom or maybe this one really, really well. But, the technicals to me are suggesting that the dollar could go higher. It's having a pretty good day today, particularly against the Japanese yen. You can see it's trying to get above its 50-day moving average. It's fighting with it as we speak. This is a buy signal on the MACD, and we're not overbought right here. So the dollar could see some more upside. The correlations have been breaking down a bit. Here is the dollar having an up day, and all the while, for example, silver is up 4.5%. So this notion that a strong dollar, at least on a day-to-day basis, is bearish for commodities has not been playing out as well. Again, gold is actually up 0.67% while the dollar is rallying today. So, and I've preached this for years, gold in particular. People think, well, it's a counter correlation to the dollar. And I say sometimes it is, sometimes it's not. Right now, it's probably reacting positively to the lower jobs number than expected, and the belief that the Fed can cut interest rates, and that by itself is bearish the dollar, cutting interest rates, but bullish gold. But right now, the dollar is rallying in spite of that. But this is more a reaction to what's going on in other central banks in other countries, particularly Japan today. And then lastly, and then I'm going to shut up, this is the 10-year yield chart, my technical analysis of 10-year yields. And you can see today they've come off the boil. They were up early in the day. I think if the Supreme Court were to rule against the tariffs, I think the 10-year would spike, and I think that bonds would sell off and yields would rise. Again, that decision was delayed, and we got a weak jobs number. So you can see this right here that the 10-year once again tested this 420 level, which was strong support, but once it breaks, it becomes strong resistance. So this is how the technicals work, or one way they work. You can see here for the past year, support right at that level. It broke, then it's resistance, big time right here. This would suggest that the risk may be to the downside in yields, and that would suggest that more potentially negative economic data is to come. But like I said, lots to play out in the short term and in the long term. And I'll stop right there. Folks, thank you. I appreciate you, as always, for watching and listening. And I'll be back soon. Take care. Bye-bye.